Thank you all for tuning in. Now, I can't promise you the outcome that you're gonna get from watching this, but what I can tell you, if you apply what you're about to learn, this will change your financial future. If you're here, it's probably because you're ready for change. And what you're gonna learn in tonight's training will do just that. So if taking back control of your money isn't enough to keep you glued to this screen for the next 90 minutes, I think it's time to reassess your priorities. And tonight, we've got a special guest. My good friend Brian is gonna be doing the training, and here's what you can expect to learn. Number one, you're gonna learn how to take back control of your money. And you're gonna do that by learning how to be the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses. And you can do that without working harder, without working longer, and without taking on any additional risk. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. That's exactly what you're gonna learn in tonight's training, so get ready, get set, let's go.
Take back control.
Tuesday night.
Tuesday?
So let's kind of get started. So when I think about control in my life, there's three things that I want to control. And many of you have seen me do this kind of this part of the presentation before. But for those of you that are new to this presentation or haven't seen me present before, what are kind of the three things that you believe in life that we should control? Like there's three main things. There's lots of things we should control, but there's kind of three that are kind of at the top of that list. So anybody want to use that chat box, use the Q&A box? What are three things in life that we want to control or that we should control or feel like we should be controlling? So Angie says health, income, happiness. Those are great ones. Thoughts, actions, time, and money from Brady. Summerton says health, home, money, time, and money, and wife. Anthony, we're not going to go down that road again. So one of the first ones that people always say is going to be money, right? Because money is a tool. Money is a resource that we can use to do things in life that we want, right? So money is a big one. Now, with money, though, oftentimes the challenge is that we give control away. We oftentimes give control of money away to other people. When you have, bank debt, when you have like a 401k in the markets, you have your money in mutual funds, things like that, you're actually giving control away. So the more that control we can get of money, the more we can control different things of our life. So that's obviously a big part of what we're going to be talking about in this presentation. Now, the other one that everybody talks about is time as well. Time is one of those things that once it's gone, it doesn't come back. Money can come and go, but time, it doesn't come back. And yet it's incredible to me how easily we give away time for money. But why is that? We trade time for money. Time is our most valuable asset, by the way, but yet if someone's paying you for that time, it's because they're making more money off of your time than they're paying you. So it's kind of a weird thing to think about that. So controlling your time and money kind of go hand in hand a little bit. But there's one thing that a lot of you have mentioned that you have to control before these two things. And that thing is your mindset. It's what's going on right here. Because if you don't control your mindset, somebody else is going to control it for you, right? That's what's going to happen. That's called subconscious programming, by the way. I'm kind of really into that kind of thing. But if you don't control your mindset, you're going to have beliefs around things like money and time that might not be correct, or you might be being controlled. So once again, three things that I believe that we should all want to control is money, time, and then of course, mindset. Mindset to me is the first one. All right. Okay. Now, before we get into this, there's some things I want to share with you. So this is a quote that we at the Money Multiplier and the BYOB team here really believe in. And it's by Will Rogers. And it says this, it says, the problem in America isn't so much what people don't know, it's what people think they know that just isn't so. So why do I say this? So as we go through this presentation, especially if this is your first time here, keep an open mind. Keep an open mind about what we're going to be talking about, the concepts, the strategies, and things like that. And there's a lot of people here that are actually already working with us that I know will comment as well as we go through the presentation. So just keep that open mind as we go through this. All right. Now, I want you to envision this. Whoops. I want you to envision this. I want you to envision that you have 100 people. Now, these are all 18-year-old kids. You put them into a room and you ask every single one of them, where will they be at the age of retirement? Will they be, poor and broke, or will they be successful? Well, they're always going to say they want to be successful. They're going to be millionaires or billionaires or whatever. They're all going to want to be successful. But here's the crazy thing. Here in America, 5% of people that, when they hit retirement age, out of those 100 people, those kids, right? 5 of them will be financially secure at retirement. Not financially free, by the way, just secure. 95% of the population of people will not be financially secure at retirement. And that's crazy when you think about it. Living here in America with all the opportunities, yet only 5% of people are financially secure at retirement, right? That's because of what we're taught. It's because of what we're taught about money, what we're taught to do with our time. We're not taught how these things really work. So we don't get to that level of being one of those 5% in most cases. So let me ask you all a question here. Who wants to be one of the 5%? To be financially secure or even free at retirement? Now, give me a yes in that chat box if you want to be one of the 5%. Because otherwise, you're going to be one of the 95%, which is not where we want to be, right? And that's why we're here, because we want to be one of those 5%. We want to know what to do. We want to know the strategies, the mindset, all that kind of stuff to be part of that 5%. Okay. Now, the crazy thing though is that 5%, where's it come from? Where's that statistic come from? Statistic. Where does it come from? Well, it comes from the Social Security Administration. They're the ones that actually say this. 5 out of 100 people will be financially secure at retirement age. So we're going to be talking about in this presentation what people do to be one of those 5%, one of the strategies that we do. All right. Now, really quick, I'm not going to cover too much about myself, but really quickly. So my name is Brian Fouts. Some of you may have heard me speak before, but I did the traditional path through life. I got a degree in construction management and business from Wazoo, or Washington State University, in construction management and business. Haven't touched that degree in probably, man, I think it's probably been 10 years since I've done anything with that degree. But I got my kind of start, in life, kind of the hard way, as I call it, that traditional path. I was raised lower class, great family. My parents were still together, all that kind of stuff, but didn't have a lot of money growing up at all. And I was told to go do that traditional path in life, right? Go to school, get good grades, get a job, get a career in corporate America, save into that 401k. I did all of that kind of stuff that I was told. And, I had the house, I had the growing family with the mortgage and the car loans and all that kind of stuff. And I was told that I had the American dream. And I remember back then, I was a success from the outside looking in, but I felt like I was drowning. I really did. I didn't like what I was doing. I didn't like my career. I was like, why am I doing this? What's my purpose? All that kind of stuff. And I didn't really know what to do different. But later on, I was in a doctor's office and I had this magazine I picked up, one of those ones they have on the tables there. Now everybody stares at their phones. Back then we didn't do that. But I picked up that magazine and it was a financial magazine, and it had this question, or this article about net worth and millionaires. And it said that the average millionaire knows their net worth, whereas the middle class person doesn't. And I didn't know what my net worth was. So I went home and did the math, and that was it right there on that page. I had a negative net worth after about 10 years in corporate America. And I did the math moving forward, and it just got worse and worse. I was like, what the heck is going on? It was kind of scary, right? And I was like, man, this is all I know. And I'm doing what everybody else around me is doing. So I knew that if I want to do something different in life or have a different result, what do I got to do? Something different, but I didn't know what that different thing was. But then something really happened that really had an impact in my life. And we all have these kind of epiphanies. And this was just something that really kind of scared me. So my grandfather, he was like my idol. I loved him. He was a coach at the local high school, but he worked really hard. And he worked up until age like 60 something, 65, 66 to retire. And he wanted to retire and then go travel around and look at sporting events because he's big into sports with his wife, my grandmother. And he did that. He retired. They bought a motorhome. But within about a year and a half or 2 years, he got real sick. He got Parkinson's as well, leukemia, kidney dialysis, all this kind of stuff. And he was basically bedridden, couldn't travel, and then he eventually passed away. And it really kind of had an impact because I saw this person that I loved not be able to live that life in retirement they wanted to. And so one of the things that he kind of told me right before he passed away was, go build your life now. Go do what you want to do now. Go do that. And so I kind of took that to heart. But it didn't happen for me for a while, but I got into real estate, got into entrepreneurship, and ended up, getting into e-commerce and digital businesses, and started building some businesses. And I actually acquired some businesses as well. And so this is one of those businesses back in 2021 during COVID. This was a multiple 7-figure business, Inc. 5000 business. And part of how I was able to do this was through the strategy we're talking about today, infinite banking. It allowed me to do some really cool things, build some really cool businesses, and have a lot of cool experiences. So I like experiences. Like for me, what I want to control is time beyond anything else. I love controlling time, and money's fine, but I love to have experiences with my family. So I've done a lot in the last, I call it 10 years that I never thought I'd do in my life. I love cars, by the way. I'm a classic car guy, but yeah, had a lot of fun and stuff. But I did this because of learning and changing my mindset. And I was even able to speak on stages about this concept and help other people do it. I've helped, thousands of people do this concept throughout my journey. And so That's why I'm here talking to you about it, because I really have a passion for what this can do and for how it's changed my life and how it can change your life as well. So let's kind of get into some of it. Now, one thing I want you to understand, that this concept we're talking about here today, it's not new. It's not a new concept, been around for a couple hundred years. So who else is talking about it? Well, most of you heard about Robert Kiyosaki, Rich Dad, Poor Dad, right? So he talks about this concept in his book, Second Chance. And actually, one of his advisors was my mentor. So I work with a lot of Robert's advisors. I have in the past with my businesses, but one of them was my mentor. That's where I learned it from. Tony Robbins, I've been to a lot of his events. He actually talks about it in his book, Money Master the Game. And then, of course, there is kind of the foundational book about this concept, Becoming Your Own Banker, Unlock the Infinite Banking Concept by R. Nelson Nash. He's the one that kind of really popularized the concept. I do recommend these books, by the way. And then one of my mentors and friends now is Chris Naugle and Brent Kessler. They have a book, Mapping Out the Millionaire Mystery, that talks through this concept. And then also Chris has a book called The Private Money Guide, the real estate edition. And for any of you that want the bottom two books on PDF, I do have a link that I'll give to you at the end, or you can email me. I'll give you my email here towards the end of the presentation, and I'll send you a link to those two books right there for, there's no cost like that, but you can have those ones and some other resources too. Okay. Now, one thing also to understand with this concept is who's used it throughout history, because if this is your first time hearing it, well, guess what? It's been used by lots of people that you might know. So a good example is Jim Harbaugh. I think I'm pronouncing his last name correctly, but he was actually paid his salary through a cash value policy, which we're going to be talking about. So he actually was paid by the college through this method. It's kind of cool how they did it. This gentleman, he might remember who he still is, but our former president, Joe Biden, he has, I think, 6 of these policies, and he actually talks about it, or his wife talked about it at one point on an interview. So there's a lot of politicians, we believe, use this strategy. Walt Disney, probably heard of Disneyland or Disney World, right? So back in the day when he was trying to get Disneyland started, he didn't have any financing. He couldn't get any financing. And so he actually had a policy and used that to start Disneyland. So without this concept, we might not have might not have Disneyland as we know it today. Is kind of cool. Let's see here, McDonald's. So Ray Kroc, the guy who ended up taking over McDonald's, when he started to grow that brand, he used a policy, this strategy, being his own bank, to fund the company for the first 8 years while he grew it. So without this concept, we might not have McDonald's as we know it. Pampered Chef, she borrowed some from her policy to start Pampered Chef, which is now $1 billion business. Warren Buffett has it. It's crazy how he did that. And then lots of wealthy families throughout history for generations have used this concept. So JP's, Morgan's, Chase's, the Vanderbilts, especially the Rockefellers, I believe they were the first family to really do this back in the 1800s. And now you. So there you go. Now, also, one thing I wanted to make sure you understand. So what will infinite banking, that's the strategy, infinite banking, what can it do for you? So a few things that it does. So one, it creates guaranteed generational wealth day one. Not year 40, not 10 years down the road, but day one, it creates generational, guaranteed, tax-free, by the way, as well, generational wealth. So it's pretty powerful in that regard. It also allows your money to grow uninterrupted, compounded for the rest of your life with guarantees. So I like the word guarantees, by the way. I like guarantees, but it allows you to grow uninterrupted. Now, I don't know of very many other concepts or strategies that allow it to grow uninterrupted, compounded. So it's called uninterrupted compounding. It's very cool when you see it on the later on, but yeah, it does that for you. Now, this is a big one. Remember, I mentioned control at the beginning of the presentation. So it takes control of your money away from the big banks, and we're going to talk about what they do with your money, away from Wall Street, right? Away from them, and puts that control into your hands. So this is one of the best ways I've ever seen to control your wealth, put that control into your hands. It also protects your money. So protecting your money is very cool, right? But we spend so much time making our money, we also want to protect it. So this protects it from lawsuits, bankruptcies, divorce, court orders, creditors in most states, by the way, not all states, but most states, it does protect it. And then, of course, the main thing that we focus on here, it allows you to be the bank for the things that you may normally use a traditional bank for. So think of things like real estate investing, a lot of real estate investors, college, cars, homes, investments, retirement, all of those things, while still having all of the benefits listed above. So a question for everybody here on the presentation. So would you like to have all of these things happening for your money and in your life at the same time? Yes or no? Give me yes in that chat box, because most strategies will do like maybe one thing or maybe two things. But with infinite banking, it does all of these things at the exact same time. Not just one, not just, like that, but all of them at the same time. So that's what makes this strategy very powerful. Okay. So it has layered benefits is what I would call it, layered benefits. All right. Now, as I said, as we go through this presentation, feel free to ask questions, use that chat box, use the comment box, whatever you need to use. Someone said, I need your info to make a phone appointment. Yes. So somebody said anonymously, yeah, we'll do that here in a little bit. So yeah, so use that chat box, take notes if you want, but yeah, ask questions. All right. Okay. So this is kind of a funny analogy, and I like this. I like this analogy. So in life, who learns quickly? Okay. Well, kids learn very quickly. Remember, like riding a bicycle, right? If you don't ride a bicycle for years, you hop on one, you can ride it again. It's pretty easy to relearn it, right? But you learn as a kid. Now, here's the thing. What if you hopped on a bicycle though, and it didn't operate the same way? What if you turned the handlebars to the left and the tire went to the right? It's called the backwards bicycle, by the way. You can actually Google it. There's videos of it, and it's pretty funny to watch. And this guy tries to ride the backwards bicycle, but he can't because he doesn't have the knowledge of how to ride it, but he falls down, that kind of stuff. But over time, he learns how to ride the backwards bicycle. Okay, so he learns a new way. But what happens when he tries to go back and ride a regular bicycle? He can't ride that one anymore because he learned to ride the backwards bicycle. He reprogrammed himself, right? And now he can't ride a regular bicycle. So why am I mentioning this? Why am I giving you this analogy? It's kind of the same thing around money. We're taught how money works, right? By the powers that be, if you want to call them that, so they can control our money. Okay, but that might not be the right way to use your money. So as you go through this presentation, we're going to learn a different way around money, of how it works. So keep that open mind, because once you learn how this works and how money really works, it's kind of hard to go back to the regular way of thinking around money. So once again, we're going to be talking about where your money goes first. That's a big part of this, is where your money goes first. Okay. All right. Now, quick question here for us to kind of consider is, why aren't more people successful in life, especially when it comes to money? Okay, so this is the mysteries of money. So I'm going to go through this pretty quick. So what kills wealth first off? Well, taxes, right? Taxes is one of the biggest killers of wealth. Inflation, right? That's called the hidden tax right there. Volatility. A lot of things that we do with our money or put our money into are volatile, right? And so that can cause you to lose money. Interest, man, the amount of interest that the average family pays over their lifetime is staggering. It is staggering. So that is money that is going out to somebody else, not to you. Okay. Mindset. Okay. Following that status quo. That's a big one right there. Fear of missing out. Fear makes us do things that we shouldn't do with money, or makes us not do things that we should do with money. Life in general, of course. And then just what we're taught. Somebody already mentioned that, right? What we're taught as we start out in life around money oftentimes is not the correct thing. And then, yeah, Frank banks. Yes, banks actually love your money. They use your money. We're going to go through how banks use your money to make money. It's just, man, what they do and what they're allowed to do with your money should be illegal. All right. So what's the definition of money? So as we go through this presentation, when we think about money, all it is a means of exchange, right? That's all it is. Okay. It's just a tool that we use. That's it. Now, what company uses compound interest? Well, think about this. A lot of people would say, well, banks use compound interest. No, they don't. They really don't use compound interest. Not a lot of companies use compound interest. They actually will pay it sometimes, but they won't use it. It's pretty weird how that works. But yes, so think of what a bank does. When a bank, when you go put $20 into your account, what do they do with that money? Well, they don't just put it in the back in a box with your name on it. What do? They put it into motion. So we're going to talk about how they do that. Another question to think about here really quickly is, are your dollars worth more today or in the future? Okay. So money is worth more today than in the future. So think about how much, candy a dollar bill would buy today versus like 20 years ago. I remember going into a candy store and buying a bunch of candy for $1. Now I might get like half a candy bar. It's crazy how it's changed over time, right? So your money is worth more today. So you want to use that money today. Also, think about this. Will taxes go up or down? Well, if it was up to you and I, they would go down, but it's not up to us in most cases. Taxes typically just go up. All right. Think about this. Would you wait to eat bread or drink milk? What do I mean by that? Would you go buy some bread or buy some milk, put it into your freezer, and then wait 5 years to eat it or drink it? No, of course you wouldn't do that, right? You'd want to eat and drink that now. But here's the thing. What do we do with our money? Well, we put it into vehicles like a 401k, so we can't use it now, but we use it down the road. So we do things with money that we wouldn't do with things that money buys, which is kind of a weird thing. Like you wouldn't go buy a car put it into your garage and then not drive it for 5 years. If it's a regular car, you wouldn't do that. You drive it now. But we do that with our money. We park our money in the garage and don't use it. We wait until down the road to use it when it's actually worth less. Kind of a strange thing, but that's what we're taught to do. Think about your retirement account. Okay. Is your retirement account, are the dollars inside of it going to be stronger today or stronger down the road? Well, they're stronger today, but you can't use them today, which is kind of strange. So with a retirement account, a 401k, what you're doing is you're giving up control of that money today for hopefully more of it down the road. Okay. Now think about it. A lot of people say, well, Brian, but the 401k and IRA, those are tax deferred. That's a bonus, right? Well, no. Why are they tax deferred? Because they're going to charge you more down the road. That's how a 401k works. It's kind of interesting. So think of it this way. Think of like if you're a farmer, by the way. If you're a farmer and you go and buy $5,000 worth of seed, right? Grain or whatever it is, you're going to plant it. You plant that and then you sell it for, $500,000 down the road 6 months later. So let me ask you a question. Would you rather pay taxes on the $5,000 or on the $500,000? Well, if you understand how math works and how interest works, you'd rather pay it on the $5,000, not on the $500,000. Yet, but here's the thing. Most people that have a job with a company that has a 401k are doing the opposite of that. You're paying the taxes on the harvest, not the seed. So once again, we're taught to do things with our money that when you sit back and look at it, really don't make sense. Okay. All right. So let's talk about how money flows. So let's look at this example of how money flows with a bank and a transaction that a lot of us are familiar with. So we're going to use the example of a car. So let's say that you're going to go buy a car for $25,000. Doesn't matter the kind of car. And let's say that you have a bank that has $25,000 in the bank. Okay. And so you're going to go take the cash out of the bank and go buy the car. But let's say the banker says, well, wait a second, Mr. Brian, before you go and do that, how about this? How about you leave the money in the bank and we'll give you 4% on that money. And then we'll give you a loan for the car and we'll do it at maybe 6% and we'll do a 5-year note, which is 60 months. Okay. And we'll use your cash in the bank as the collateral for that loan. So once again, you're going to leave the money in the bank at 4% and you're going to get a loan for $25,000 from the bank. Okay. So how's the math work on this? So your monthly payment on the car note is going to be $483. Okay. That's going to equal $28,999. I'll just round up $29,000, right? Of future payments. Okay. So that's the value. That's what the bank is going to be getting back from you. But what about your money that's in the bank? Okay. What's that? The future value of that is actually $30,525. So if you do the math on this, you made $1,526 because your money in the bank is compounding on a larger balance and you're paying a 6% on a decreasing balance. So this is how math works. This is just math. Okay. So this is kind of the mindset side of things. You got to understand that when you look at money, you got to understand how money works to make sure that being in the bank makes sense to you. So this is how it can work right there. Now, someone says, well, Brian, but if I paid cash for the car, I wouldn't have any payments. Well, yes, but here's the question to think about. How did you build up the cash in the bank account in the first place? By saving it every month. So if you pay cash for a car, you have no more cash. You have no more future value of that money, but you're going to want to replenish your bank account. So you're going to keep saving again. So this is the same cash flow, except you've made money in this scenario. Okay. Yeah. An anonymous person, I see your email there. Yeah. So I'll definitely send you something. And then, so someone's asking here, how does the insurance company guarantee uninterrupted compounding forever? Well, it's contractual. So they have a guaranteed return inside the policies that grows no matter what. But these companies have been profitable every single year they've ever existed. They've never lost money. Like there's companies that are 190 years old and they've never lost money. They've always been profitable and they have massive reserves. So that's how they can do it because they've never defaulted. There's never been a company that's gone under. Nothing never happened. So they're considered to be some of the safest, if not the safest places to park your money. Yeah. Yes, Beatrice, there will be a replay of this. It's being recorded for sure. Okay. All right. So here's what we're going to be talking about as we go through this presentation. So there's 3 things we're going to be talking about. The first one is going to be the machine, right? How does this thing function? What is the machine that makes it work? The next thing we're going to be talking about is the marathon, because it's not a sprint, it's a marathon. right? Okay. And then the last thing is the millionaire. How do you build wealth? How does this really help you build wealth in your life for yourself, your family, and the next generation? Okay. So that's what we're going to be talking about. Real quick. So someone said, Chris says, putting money into traditional avenues like 401k IRAs would make more sense if the gold standard had never been abandoned. Exactly. I agree with that 100% because you wouldn't have all the ups and downs and the money printing. Angie said more banks go bankrupt than life insurance companies. Well, yeah, and that's a great point, Angie. But the companies that we use for this concept, there's never been one that's gone bankrupt. They've never gone bankrupt. Life insurance companies that go bankrupt, if you look into history, are typically a stock company, which is publicly traded and publicly owned. These are not that. These are different than those kind of companies. They've never gone bankrupt. So good point though. All right, so let's look at the machine. Okay, so the machine that allows infinite banking to work is like an engine in a car. So I like analogies, right? So think of infinite banking like a car. Okay, a car has tires, wheels, brakes, hopefully a windshield, a radio, seats. Now, can that car go down the road if it has no engine? No, it cannot. So we have to have an engine. In this strategy, infinite banking, the engine is nothing more than a dividend paying whole life insurance policy from a mutual company specially designed, which there's not many people, by the way, that can do this. We think 99% of people out there that are agents and stuff can't do this, by the way, but it's specially designed for infinite banking. So that is what the machine is. Okay. Barb, no, you're not. At 70 years old, no, you're not. My oldest client is 74. So that's just going to give you a heads up on that one. Okay, so you might be thinking, well, like life insurance, why life insurance? Well, you saw the stuff that I showed you before, all the benefits. That's why. Okay. Now, something to keep in mind. Okay, so there's something called bank-owned life insurance called BOLI. So banks, which you give your money to when you deposit at the bank, they own more life insurance than they do their entire buildings and real estate combined. So they're taking your money and doing exactly what we're going to be talking about in this presentation. That's what they do with your money. So what were we doing? We're talking about doing things that the banks are doing with your money. So bypass the banks and do what they do with your money. They own a lot of this stuff. They've quadrupled the amount they've owned since 2016, by the way. I think maybe it's 5 times now. They've quadrupled it. Gee, I wonder why. All right. And actually, I had a client who was going to go do a presentation to a local credit union. The president, the manager of the bank, right? I can't remember what the presentation was on. But I said, hey, when you're doing the presentation, before you start, ask them if the bank has life insurance policies on them. Every single manager and president and VP said, yes, the bank has life insurance on them. So that's what it does. And yeah, Anthony did put it right there. BOLI. Yep. It's pretty interesting how they do that and why they do it. Okay. So I showed you how the money flows here, that you can make more earning 4% while paying 6%. Okay. So that's what you can do by being the bank. But in this example, the thing is that you are only on one side of the transaction. You're the borrower. Okay. So what if you're on both sides of the transaction? You are the bank and the borrower. Okay. Because that's liabilities and assets. You own both. So it's kind of to understand this. Let's see what a bank does with money. So this is how banks work and how they function. It's pretty powerful. So let's just say that as an example, you deposit $100,000 at your local bank. Okay. And let's just say they're a nice bank. They're going to be very friendly. They're going to give you 4% on your money. Okay. So what does the bank do? So that, by the way, when they do that, that is a deposit. That is a liability to the bank because they now owe you money plus 4%. So it's a liability. Okay. But if you understand assets and liabilities, the bank doesn't sit there with that liability. They create assets. So they do that by lending money. Somebody already said that previously. So maybe they lend it out on a 7-year ARM or something like that for a home at 7%. But what does the person that sold the home do with the money they got? Well, they might pay off some debt, but bottom line, that money goes back into a bank eventually. What's the bank do with that deposit? Okay, same thing. They turn around and maybe it's a high interest credit card or car loan, something like that. But what does the car company do, right? Well, they don't sit on the money, the cash. They don't leave it in cash. They put it into a bank again. Okay, what's the bank do? Same thing. They put it right back out at maybe on a home remodel at 9%. What's the contractor do? What do the subcontractors do? What do the employees do? They put it right back into a bank. Kind of get the picture here. See the whole circle? They lend it right back out. Maybe it's on a debt consolidation loan, something like that. What's the credit card company do? Puts it right back into the bank again. So the bottom line is the bank receives your money as a liability, but what do they do with it? They put that money into motion. Money in motion makes money. So the bank actually makes 500% more than they're paying you on your money. So they make like 20%. Now you might be saying, well, okay, really, that's how banks function? Well, guess what? You can go look at bauerfinancial.com and it'll tell you how much banks make on your money that you leave in your bank account. So they make between 400 and 1300% on that money. And you can go back in history and look this up. It's incredible. And Anthony put something inside there, said 80% of banks nationwide with assets between 500 million and 10 billion own bank-owned life insurance. We believe that they have billions upon maybe even trillions of money in policies. It's incredible. But yeah, it's pretty powerful, but you can go look it up right there. Yeah, this is not stuff that we're making up, right? Now, to understand why being the bank makes sense for like myself as the individual, okay, let's look at the annual pattern and spending of money for the average household family. Jeanette here said, then why would a bank ever go out of business? Because that's a great question, by the way, because they do other things with money that are very bad. So there's a thing called fractional reserve banking where they can lend out 9 times what they take in. And so then when you have a big change in the economy, banks can get hurt really bad because they're doing something called fractional reserve banking, which is very dangerous. And to me, it shouldn't be illegal. It's money printing, and it's what creates inflation, by the way. But that's what they're doing. They're doing other things because they also invest your money. So banks invest. So they do life insurance, but they also put it into things like, you know, mortgage-backed securities or things they did back in 08 and 09. They buy things, and then if the market changes, all of a sudden they're going to lose a ton of money. That's what's happened. So they do bad things with money too. Yeah, and they're doing it with your money. So, all right, the annual pattern of spending for the household family. So let's look at how, like, when a dollar comes into your family or your household, where's it go? Okay, so for every dollar that comes in, around 20 cents of every dollar goes out to automobiles. Okay, so 20 cents goes to automobiles. Around 30% goes to housing, mortgage, rent, things like that. Around 40% goes to everything else, like travel, entertainment, food, clothing, that kind of stuff. Okay, and then that's 90 cents right there. So 90 cents of every dollar that you bring in, on average, goes right back out to somebody else. Okay, so that's where it goes first. Doesn't go to you first, it goes to somebody else, right? You're not paying yourself. And then what's left over? Around 10%. And that varies. Before COVID, it was like a negative number of savings for the average household. Right now, I don't know what it's at right now. During COVID, it was actually a higher number, like 15%, but I just say 10%. So 10% of every dollar you have goes to savings. Now, if you go talk to a traditional financial planner, what do they focus on? They focus on your savings. That money you're putting that, into that 401k or aside for investing on the 10%. We want to build the 10%. We want it to be more. So we're going to focus on the other things first. So here's a different scenario. Let's look at the interest you're paying on those first 3 categories. So on automobiles, so around 5 cents of every 20 cents that you put towards a vehicle is interest. Okay, so let's take that 5% and recapture it back into our savings. Okay, we've recaptured. Now our savings grows. What about housing? Well, if 40 cents goes to housing, what's kind of scary is around 30% of that 40 cents is interest. If you're renting, by the way, it's all gone. But if you have a mortgage, it's around 30% or 30 cents. So let's recapture that 30 cents back into savings again. Okay, now your savings is growing. And then everything else, so that's travel and stuff like that, that's 40 cents. Around maybe 5 cents of that 40 cents is also interest. So let's recapture that as well. Okay, so what we're talking about here is actually recapturing and controlling more of your money so that you keep more of that in your control instead of going out to interest to other people. That's really what we're looking at. So how you spend your money and where it goes first is extremely important. So once again, this is mindset stuff we're talking about here. All right, now let's kind of look at some actual examples of how the math would work. Let's use an example of something that we all have typically done, which is buy a car. Now, granted, it's probably hard to finance a Shelby Mustang right there, but I love classic cars, so I like that picture right there. But we're going to look at how you can get your money back and retain control of it, even when you're doing something like buying a car that we're familiar with. Now, this can work for investing, for real estate, but let's look at a car. All right. So let's kind of look at this. So let's look under the hood of how this is going to function. So this on the right-hand side is called a policy illustration. You don't need to understand all the ins and outs of it right now, but this is what's called an illustration. So a couple of things you're going to hear me talk about. So when we have this policy, we're going to be funding the policy. Those are called premiums. So if you have a car insurance, there's a premium. Okay. In this case, you're going to hear me call it premium deposits. Why do I say deposits? Because you can utilize those deposits. You can be your own bank. So it's not just a premium or an expense, it's a deposit because you're depositing it into your own banking system. Okay. Age. So age is a big one. So people say, well, Brian, okay, I get it. We're talking about the specially designed whole life policy, but what if I'm 70 years old? Well, age doesn't typically matter. You can do them up to age 74, but you can also do these things on other people, and you are the bank. So you can own them on your spouse, kids, adult kids, business partners, siblings, etc. Okay. So they're very versatile in that regard. Okay. Death benefit. So you've heard me say life insurance a couple times, but we're not going to be focusing on the death benefit per se, because that is a benefit, but it's a death benefit. We're going to be focusing on the living benefits, because when you deposit into your policy, you're going to have what is called cash value inside the policy. Cash value is what you can borrow out to go do things like we're going to be talking about. Okay. So death benefit, it's there, it's guaranteed, it's tax-free, it's generational wealth. But what we're going to be focusing on mainly is the living benefits, which is the cash value and other benefits inside the policy. All right. So let's set up a policy. So I'm going to be very conservative with these numbers, by the way. They're typically a lot better than this, but I want to be very conservative. So we're going to deposit into our banking strategy $10,000 per year. That could be done monthly, could be done quarterly, can be done annually. I'm going to use an annual number, and I'm going to use a round number of 10,000. It could be, it's going to be up to you what you put in, and it can vary, but this is just an example. Okay. I have people putting in 50,000, some people putting in 5,000, but we're going to use 10,000 right here. Okay. So as you fund this $10,000 or put this into the policy, you're going to have cash value inside of this thing. It's going to grow. Okay. It's going to grow every single year or every deposit. It's going to grow with dividends as well. We're going to talk about that in a moment, and it's going to keep growing for the rest of your life. Now, in this example, we're going to say at year 3, we're going to go get a car. We're going to go to our bank. We're going to borrow $25,000 out of our banking policy. That's our capital. It's our loan. We own that loan. Okay. Now, we're going to pay back our banking strategy just like any other traditional car loan. So let's go at $6,000 per year. That's $500 per month on a 5-year note. So what does the math show us right now? Well, we've deposited $70,000 into this policy. We've also paid back on the loan $30,000. That's $100,000. Okay, makes sense. But we've got to remember that we actually had $25,000 in cash. So we took $25,000 out in cash to go buy the car. We could have invested it in the real estate, by the way, or college or whatever, but we're using the car example here. Okay. So in reality, $75,000 is what we've put into this whole thing. Okay. Now, if you look at it though, we have $67,000 of cash value inside this. We've recaptured 91 cents of every dollar so far, and that's in 7 years. Okay. But now how's this thing really take off after year 7? So this is where it gets pretty fun. So let's look at years 8 through 12. Now, years 8 through 12, we're going to put in 0 deposits. That's an option, by the way. You can actually reduce it if you want down to 0. So we're going to put in nothing after year 7. But here's the fun thing. Because this is a mutual company paying dividends, it keeps going up. The cash value keeps going up. Okay. And Rob, I'll answer that question here in just a moment. Okay. So you're still growing. So in year 8, you go and borrow another $25,000 from your policy to buy another car. Okay. And you do the same thing again. You pay it back with interest back to your policy. That's $6,000 per year. So in years 8 through 12, what have you done? Well, you've put in an additional $30,000 in the loan payback, but you also had $25,000 of cash. So you only put in $5,000 in years 8 through 12. But here's the math on this. You put in $5,000 in years 8 through 12, but the cash value from year 7 to year 12 went up by $23,592. So it went up by a massive amount. Okay. Now here's the other thing. If you look at the total math, how much have you put into this policy in these 12 years? Well, $75,000 in years 1 through 7 and 5 in years 8 through 12. That's $80,000. But the cash value that you can borrow from this thing is $91,000 and change, meaning that you have more inside of it than you put into it. And that's just going to keep getting bigger and bigger and bigger for the rest of your life with guarantees. So, and you can use that money for whatever you want. Now, to answer Rob's question, do you have 25K in cash value after year 3? Yes, you did. So what you're going to see here is at the end of year 2, you have 12,215. And then in year 3, you have right around 25,000 at the end of year 3. But what I'm showing here is only $4,000 of cash value remaining to borrow against. You still have the 25,000 in there, right? I just show that we've borrowed it out. So I'm showing the amount available for additional loans to yourself is only 4,000. But yeah, you did have 25 in there. Yep. Okay. So there's 3 rules we talk about with infinite banking. Rule 1, pay yourself first. Okay. That means put the money into here. Rule 2 is pay back your policies. So be a responsible banker, pay back your policies with the interest. And then number 3, use that cash value, put that to work for you. So here's those rules: pay yourself first, pay yourself with interest, and recycle and recapture your money through your policy. That's how this works right there. So hopefully that made sense. We're going to go through some more examples of other things too, but that's infinite banking right there and how you can pay back those cars. Now, the last thing I didn't mention, you had $80,000 in the policy you put in, but you had 91,000 of cash value. You also have 2 cars that you own outright. So don't forget that. 2 cars that you own outright, maybe they're worth, $20,000 combined. So think of that as an example. If you just got a car loan, you'd have 0 net worth and own 2 cars. With infinite banking, you have $91,000 and you have the money. Now, another question that came in is right here is, well, where's the $10,000 come from? Well, that can come from wherever you want. Disposable income. It can come from money that you're putting towards maybe a 401k, and now you're putting it into the policy, savings, whatever. Okay. So, and I'm going to do another example here and I'll explain to you where this gentleman, how he funded his policy. Okay. All right. So another thing that a lot of people use infinite banking for, and I know there's some people on the call right now that have done this, is debt. So debt is one of those things that just steals wealth away from us because we're taught that debt is the way to live. Car loans, student loans, mortgages, credit cards, you name it, right? So one of the best ways to build wealth is to, 1, get rid of the bad debt, okay, which is taking money away from you, and then start putting that money to work for you, okay? But the first step is recapture those debts. Yep, yeah, Anthony knows what I'm talking about because he's done this. So infinite banking can be a great way to recapture debts, okay? And we're going to go through this. Angie said, what's the average return and dividend? Between 5 and 7% for the last 20 to 30 years. Yeah. Yeah, we have some graphs on some of the companies that show what it's been for the last 30 years, I think between 5 and 7%. Okay, so here we go. So this is a doctor, by the way. So this is a doctor. So this is his debt. Your debt is yours, okay? But this is a doctor. His total debt is $478,000. Okay, so he's got quite a bit of debt. His monthly payments on that debt is almost $6,000. It's $5,777 every month. Okay, it's quite a bit going out the door. If he paid all these debts off traditionally, it would take him 19 years. Not a short amount of time, by the way, 19 years, okay? So now this doctor is going to start a policy, okay? And get it set up here. Okay, he's going to start it with $25,000. He's going to do an annual premium. So at the beginning of every year, he's going to do a $25,000 deposit into his banking policy. Now, where's that money coming from? Well, this doctor had money going towards other investments like mutual funds, things like that. And, they were volatile, going up and down, et cetera. So he decided to take that money and put it into the policy instead. So that's where it came from. So his cash flow didn't change. He just redirected some money from this bucket to this bucket, okay? All right. So when he deposits that $25,000, he immediately, within 30 days, by the way, has access to around $14,863 of cash value. Now, by the way, that's extremely conservative. Most of the policies that I build is going to be higher than that. But once again, I want to be conservative, okay? All right, so what does he do? So now he goes to his bank and he borrows out $14,863, okay? He uses that to pay off the Discover's, Lowe's, and Nordstrom credit cards, okay? That's what he did. Or part of the Nordstrom card, I guess, part of it, not all of it. And his debts dropped down to $463,000, and his monthly payments, they reduced. So they reduced by $448. Frank, great question. Why not the 2.1% first? He says. I think you're saying the 21%. It's not about the interest rates. Oh, the 221%. It's not about interest rates. It's about cash flow. So it's the volatility of cash flow is very powerful when it comes to interest. So it's the volume of interest, not the interest rates that you're looking at. And we have math that does this for you. So it just tells you which ones to do first. So you're recapturing the cash flow. That's what's going on. Okay. So now what does he do? So that's year one. Okay. What does he do in year two? Well, in year two, another $25,000 goes into the policy. And now it goes up by $16,571. So you see how it's increasing the amount he gets every deposit. Additionally, that $448 every month that he was recapturing, he holds on to that. He doesn't let it go out the door. He holds on to it, okay? And he keeps that money. So in total, he has now $21,945 of cash available. He borrows that out, and now he pays off the Nordstrom card, Wells Fargo private loan, and part of his BMW loan, okay? Yeah, he pays that off. Okay, now what happens? Well, his debt's decreased by down to $378,000, and his monthly payments now have been reduced by $1,917. Okay, what does year three look like? It gets really fun when you start getting into the years on this one. Now he puts in $25,000, but now the cash value jumps up by like $25,000 or something like that. It jumps up quite a bit. Okay, the $1,917 payments back to himself, that equals $23,000 and $23,004. And so the total cash he has now is $48,545, right? Same thing happens. He borrows out of the policy, pays off the BMW, West Marine, and part of the condo, okay? His monthly payments have now been decreased by $3,677, which is awesome. Okay, now I'm going to pause here for a second, okay? Remember the marathon. Okay, so what has happened now so far? This is in 3 years, what has happened? We put in $75,000 into this policy. Okay, he's taken out $55,000 in policy loans. But remember, these policies are earning you dividends. So how much is he earning dividends on in this policy right now? Some people say $20,000. Nope. You're earning dividends still on the full $75,000, even though you've taken out $55,000. What is that right there? That is uninterrupted compound interest. No matter what you borrow out of the policy, you still earn dividends on the full amount you put into the policy. It does not interrupt your compounding growth of the policy. Can you do that with any other financial vehicle out there? Not typically, no. EB says, is infinite banking the same as an IUL? No, it's not. Do they have some of the same features? Yes, but do we use IULs for infinite banking? Absolutely not. And I'll explain to you more about why later on in the presentation. But yeah, absolutely not do we use those. We want to have control of our money. Yeah. Greg says wrong. I think you're talking about the IUL question, probably. All right, so now let's go to year four. Okay, so year four, same thing. 25 goes in, cash value jumps up by 26,000. The payments of $3,677 back to yourself is now 44,000. Total cash available, $70,000 and change. Same thing, right? Now we borrow out that 70,000. We knock out part of the condo loan. Now, in this scenario, what happens is that the monthly payments don't change because the condo is amortized loan. And if you pay the principal down, it doesn't change the payments, okay? And then anonymous attendee, I'll answer that question in just a moment. And then same with you, Rob, as well. Yeah. And then Angie, I'll tell you about that as well. All right, so in year five, same thing. 25 goes in, cash value jumps up by 27, payments back to yourself, 44,000. Total cash value is $71,225. Now you pay off the entire condo and a big chunk of the house. And now your payments have reduced down to only $1,221 per month, right? It's crazy, okay? So that's how much has gone down by. So now in year six, what do? So this is kind of cool. So in year six, this person says, hey, you know what? I like this concept. I want to do more. So what does he do? On the first policy that he was paying 25 to, he drops the premium down to $10,000. You can do that, by the way. You have the option to reduce premiums on these things over time. But the cash value still goes up by $13,000. He starts a second policy at 25,000. So now he's got 35,000 going in because he wants to do more. So now the second policy cash value is now $14,863. His payments back to himself are $54,000. So the total cash he has available is $82,000. Okay. But he's only got a house loan mortgage of 76. So what's he do? Wipes that thing out. Now he's recaptured all of the payments that were going to the debt companies and he has no more debt. Now in year seven, In year 7, what he does, he takes that $5,777 that's going out every month and he pays back his own banking system. So at the end of year 7, 7.5 years, he has 0 debt. He has he has 6 figures of cash value in his policies that now he can start using for like investing, for college, for whatever else he wants now. So he's gotten rid of all the debt, recaptured all the cash flow, and now he can start putting that money to work for him. So you see how he flipped that thing around? 19 years versus 7 years. And now he has all this cash value to go invest and build wealth. That's what's happening right there. Very powerful. And if you're thinking, well, Brian, that sounds cool, but man, that's a lot of numbers, a lot of math. Well, guess what? We have a software that does exactly that and tells you how to do it. So it tells you how to flow the money. So Frank had a question about, well, why would you pay off the higher interest ones first? Because the math told us not to. That's why. It told us the quickest way to do it and the way to save the most amount of money. So we have software that we use to do that. No cost, no fees, nothing like that, guys. This is just stuff that we give to everybody. Okay, somebody says where to buy policy. So you can't really buy a policy. You have to have it built for you, and you have to have a licensed agent who is infinite banking certified to do that. And that's me, by the way. I am one of those people. We have a whole team that does that. Someone says, Rob said, interest and dividends are separate, correct? Yes, they are. They are separate. So to take out a loan out, it looks like my policy pays reduced interest. No, it does not. I mean, if there are 2 different interest rates, but your dividends don't change, you still earn the same dividend rate. You just now have a loan that has an interest tied to it, but they're different types of interest. The dividends are compound interest. The policy loans are simple interest. So they're different interest types. Angie says, what is average cost fees in whole life policy compared to IULs? Well, there's really no cost or fees in a whole life. There might be like an annual fee of like $75. And then if you're doing like a monthly premium deposit, there might be like an ACH transaction fee that the banks charge, like $5 or something like that. And then some of them charge like $100 or $150 startup fee at the very beginning. But that's it. There's no like ongoing like percentage fees, like a 1% percentage fee, like a 401k, and like IULs, by the way, they have like percentage fees inside of them sometimes. Man, those can erode those earnings. Yeah. So yeah. No, this is definitely not Money Max. Definitely not Money Max. And I am very familiar with what Money Max is, by the way. So it's not that at all. This Debt Blaster is our own software that we built. Money Max is just a software that shows you how to move your money through your accounts, banks, credit cards, loans, etc., to pay down debt a bit faster. It's a little bit different, but good question.
You ever feel like you don't have control of your real estate business or your money? That's right. The big banks and the institutions, they're in control, right? I know you felt that before. Private Money Club puts you back in the driver's seat. As members often tell us, it's a total game changer. Join the community of like-minded lenders and borrowers by going to privatemoneyclub.com and sign up.
Yeah, so guys, we have a team, by the way. So we have an implementation team of agents that help you use your policies the correct way. So a lot of people have policies but don't know how to use them as infinite banking. We have a team that helps you do that. There's no cost, no fees that we ever charge, by the way. So for what we do. But yeah, so you're going to have someone that holds your hand through the entire process. Okay. Yeah. Frank says, can you use this for a business? Absolutely. I mean, that's what a lot of people do. They use infinite banking policies for their business. Maybe it's as like a line of credit for the business, or a loan to the business for investing purposes, for like real estate. But yeah, we have a lot of people that do that. We have people that have used it for starting up a business, stuff like that. So now let's get down to the last kind of section, which is the millionaire. So now that you paid off the debts, right? So I don't have any debts. What if I have the cars now? I don't need the cars, right? Can I still benefit from, this strategy? Can I still become my own banker? Well, absolutely yes, because once you take care of those things, now is when you start building wealth, or having, start building that generational wealth, start doing all those other things to create more cash flow in our lives. Okay. So yes, so absolutely. So this is where the fun begins. We're going to get into that. A couple questions here. Evie says, does health issues hinder getting a policy? Yes, they can. Depends on what they are. Shane says, yeah, 2.5 years to completely reshape his mindset. Yeah. So yeah, it's been great for him. Anonymous attendee says, if you have a VUL, would you convert it to whole life to do this? Only if it makes sense. So it would have to make sense to convert it, but that's what, and I've done that before for people, but it has to make sense. Like, you would never want to convert a VUL or another policy that is performing well. And even then, those can perform well, but if they're doing well, you don't want to convert it if it's going to actually have a negative effect on your overall situation. And then Rob says, what I meant is that I had about 95K cash balance and earned about $18 per day in interest. I borrowed 85 and now it looks like I'm only earning about $2 or $3 per day. Rob, what company is that policy with? That's what I would need to know. Yeah, so what company is that with? Right? Lafayette. So that shouldn't be the case. So you should, when you borrow from the policy, if it's set up correctly, right, it will not reduce the amount you earn on the interest. Now, the dividends are paid on an annual basis with Lafayette and most companies. They don't pay it on a daily basis. They pay it on an annual basis. But I'd have to look and see what it looks like for you. But yeah, they are a non-direct recognition company, so they wouldn't pay less because you borrowed. Okay, so here's some ways that people use infinite banking, by the way, for other things, for building wealth, right? So active real estate investors, we have a lot of people doing that, flippers, buy and hold, whatever. Commercial property, so like apartments, mobile homes, etc. Private funds, so a lot of people will use private funds for lending, for investing into other people's projects. Chris has the private money club that does that for people. Business owners, somebody asked that question about business owners. Yes, business owners do use this a lot. Stocks and options traders, if you really know that space, you can do that. I personally have done a lot of day trading, but I don't use my policies for that kind of stuff. I don't feel comfortable doing that. Startups and even equipment flipping. So we have people that do equipment flipping, which is kind of a cool strategy. You buy equipment, renovate it, and then resell it for profit. And they use their policies to do that. So there are lots of different ways to do that. And I'm going to give you an example here on the next slide, an example of how private lending would look with a policy. So you'll see kind of the numbers and how it looks. And this is an actual policy. EV, can I convert my IUL to infinite banking if the policy is within the same insurance company you use? Yes, it doesn't even have to be with the same insurance company. It can be with a different company. Doesn't have to be the same company, but yes, you can. Angie, can fixed index annuity replace whole life if the person has medical problems? Yes, but the annuities are still you still have to qualify for an annuity. In most cases, they still have to qualify. Shane, yeah, he lends other people his funds. So, and he actually is using this concept to retire himself from his W-2 job quicker than expected by private lending his policy to other investors. Lisa, do you get interest and dividends on the money in the policy from the insurance company, or just dividends? Well, the dividends is interest. So it's an interest, it's a percentage, yes. So the dividends are what you get, and it's an interest rate that they calculate every year, but around between 5 and 6% currently right now. Frank, can you use your home equity to get started and work? Yes, you can. That's called a HELOC. That's the way that you can leverage another asset, which I don't consider your home to be really an asset, but if you create a HELOC, you can then create the asset of infinite banking. Yes, you can do that. And then Anthony, yeah, he paid off all of his debts like we showed, and now he's private lending. So that's the circle right there, right? You pay off those bad debts faster, recapture that money through the policy, and then you put that money to work for you. Guys, we got people doing this all day long, so it's kind of cool. All right, so let's look at an example of what we're talking about. So like, as an example, Anthony just said he paid off all his debts and then he private lends. So let's look at a policy. So this one, let me see if I can bring up my laser pointer thingy here. Okay, so this policy here, this person's going to fund it with $150,000 upfront. So what are they doing? Well, this person is funding it with $50,000. That's their premium deposit every year. Okay, and they're doing that for the first 10 years. And as you said, you can drop it down. They're also going to do what's called a dump-in or a lump sum upfront as well. They're going to do $100,000. Now, why do they do that? Well, because it overfunds the cash value very quick. 90% of that goes to the cash value, the dump-in, and they can borrow out within 30 days. Okay, so, and these are all end of year numbers. So this person at the end of the first year has 132,000 of cash value. They put 150 in, and they have 2.3 million of death benefit. So God forbid anything happens, right? But that money is going to turn into a lot more money if something does happen, which we don't want that to happen. But let's look at how this would look down the road. So let's look at year 8. So like in Shane's case, or no, Anthony's case, during the first part of the policy life, he paid off his debts. Okay, now that you paid off your debts, let's look at how you can put this money to work for you. And Angie, I'll answer that question here in a moment. Okay, so in year 8, his cash value, this person's cash value in the policy, their bank, it grew by $66,000. But how much did they put in? They only put in 48,000. So they put in 48,000 and it grew by 66,000, more than they put in. Okay, that's a cash on cash return of around 37%. Pretty darn good if you ask me, right? Okay, now what if they private lend this money? So let's say that they loan it out at 12%. Okay. And let's say the interest on the loan is, let's say, 5%. So they're earning 37 on the money in the policy. That's the dividends, by the way. They're earning 12% on the money they lent out to a private lender, and they're paying 5% back on their policy loan. That's a 44% cash on cash return. So 44%. Okay. So would you rather have 12%, right? Or 44%? So if you just lend out cash, you make 12%. Now, granted, this is 8 years down the road, but if you do the math on this, now you're earning 44% instead of 12% by private lending and being the bank on both sides of the equation. You are your own bank, so you're borrowing your money, and then you're being the bank again the second time by lending that money to somebody else. So you're being the bank twice, by the way, and you're getting 44% cash on cash returns. Okay. So pretty powerful. And by the way, at this point in time, this person has put in around $498,000, and the cash value is $531,000. So it's more than they put into the policy, and they're earning money outside of the policy as well. Okay. Pretty cool. Okay. So Angie said lump sum can cause MEC. Yes, it can, but we avoid the MEC. But we have ways that we get around the MEC. So yeah, we don't ever build a MEC policy, which is called a modified endowment contract, by the way, and is as a taxable contract. We don't ever build those. Barb says, would it make sense to do a dump in if I have a HELOC and I can take it from there? Yes, it can, but you'd have to understand, as Shane said, you have to understand velocity banking. Anthony said that. You have to understand velocity banking. And so if you understand velocity banking, which is a way to use a HELOC or a line of credit, the interest rate would not be 8%, it'd be like 4% or 3%. So it can make a lot of sense, but you have to really understand that full circle. But I walk you through that on a call. It's kind of a little bit too much for the call here, but yeah. And then, yeah, so yeah, and Anthony did what Shane said too. Yeah, right there. And then Barb, or Angie said, is death benefit increasing coverage? Yes, it is. So for the first 7 years, it might be different, but for the policy life, it's an increasing death benefit. And I'll show you that here in a moment on another. I have some more slides that show illustrations, by the way. But yeah, and Barb is talking about, yeah, that's velocity banking right there. So uninterrupted compounding. I want to mention this one last time, and I'm going to go through this pretty quick, but this is why it is so powerful, because look at this. So it's going, like, see the cash on cash return is 21% at year 2. In year 15, it's 115%. And it just keeps on going up. In year 2, by the way, this is a $50,000 dump in and a $6,000 per year premium on this person, by the way, approximately. Access to capital in year 2 is 121% at the end of the year. At year 15, access to capital, this is like how much they have access to versus what they put into the policy, by the way, is 215%. I mean, these numbers are really awesome to look at. But when you understand that, hey, this is happening even though you're borrowing from the policy to go do other things with the money, you're doing both. You're getting these kinds of returns on your money or growth on your policy, and you're doing other stuff outside the policy as well, both at the same time. So I love it. All right. So how do you build wealth? So this is something I always want to kind of share with people, because it's, it's not like snap your fingers and it happens. It's like, how do you eat an elephant? One bite at a time. The man at the top of the mountain, he didn't fall there. And so as an example, like, a lot of people are looking at the man at the top of the mountain and say, hey, I want to be there. I want to be there. I want to be there. Oh my gosh, I want to be there. But they're walking around the mountain in circles. How did that guy get to the top of the mountain in the first place? He took that first step up the mountain. And so infinite banking is kind of the same way. You got to take that first step with it and get it started, because it gets better and better the longer it's in place. Okay. So this works for debt, it works for expenses, works for things. We have people that pay their taxes with it, by the way, vacations, homes, everything else. So we have people that actually use this for lots of different things. Kind of like your imagination is the limit. Okay. Now I want to kind of flip this. I want to do this really quick, this slide, but this is kind of an interesting thing when you look at interest. So remember the homes the doctor had? Well, what if he paid those homes back to the bank as originally promised? Okay. He would have paid the banks $493,000 in total. That's what he would have paid back to them, and he'd have the homes outright. He'd own the homes. Now, what if he was the bank, though? What if he was the bank? And let's say that his bank earned him 4% on that money. Okay. He would have in his banking policies $749,000. So think of this for a second. We just flipped the whole thing around. He went from paying $400 and some thousand to having $749,000. Now, this is a very drastic example, of course, but this is why being the bank can be so powerful. It takes time, of course, but this is what you can do. Okay. All right. Anonymous attendee said, oh, I already answered that one. Sorry. And then, yeah, appreciate that, Anthony. Yeah. Yeah. So we're always here to support you. And this is another software. So you saw that real estate example right there, but this is a gains projector that can actually show you how to use the policy for investing, for like real estate, things like that. Okay. So yeah, we have lots of different things like this that we use for our clients. Okay. Now, one of the things I truly believe is that everybody should know how to do this. It's not a fit for everybody, and I'll mention that in a moment here. But like, if you understand how powerful this is and how it can work, oh my gosh, I mean, this can be a benefit for your kids, grandkids, etc. And then the last thing I'll mention here, now I have more slides, we're not done yet, by the way, but the next step really is if this is something you are interested in, you want to learn more about, you just schedule a call with me. And that's my link right there. And I'll put it in the chat box with my email address as well in a moment here. Let me grab it right now, actually, by the way. And then you could just schedule a call with me and go through your questions, go through whatever, any ins and outs you have on this concept. And there's no cost, there's no fees, nothing like that. Let me pull that up. And also I'll put in here my personal email address as well. And then I'll put, the book links too. Yeah, so the link, if you click my call link, I think it's in there, or you can just send me an email and I'll send it to you. So Angie, great question. At what age can someone get a policy? Anywhere from age 1 week, so 1 week old to 74 years old. Or you can get them on somebody else. So that's kind of and there's my email address right there. That's my personal email address. You can email me. I'll send you the book links, or if you want the replay, any of that kind of stuff, you can use that there. And then Angie said, and up to what age do you use increasing death benefit coverage? So it's always going up. So the death benefit always increases until end of life. So yeah, so it's always going up. Yeah. So this is kind of the shift that happens. This is the shift. It's you working so hard for your money to now getting your money working for you. That's really the shift that we want to see happening with infinite banking. But it starts with 1, taking that first step, 2, recapturing those debts, if that's the situation, or putting the money to work for you. So that's really kind of why I like this slide on there, because what does infinite banking do for you, right? It gets you back in control of your money. I got a dog in my lap, by the way, so that's why she's getting a little frisky. Yep. Okay. And then Mark says, do these policies have the so-called living benefits? Yes, the living benefits is the cash value that you can borrow out. So that's the living benefit aspect of this. It also has the protection, the privacy, of all of your money. So yeah, those are all the living benefits, and I'll share some more about what those are. Okay. All right. So by the way, some other things that we definitely want to make sure that we do cover when it comes to infinite banking. The death benefit. I'm going to talk about that here in just a moment, a bit more. The loans. You control the loan. The loan is your money, by the way. It does not have to be repaid, although we say you should repay it, but it doesn't have to be. It's tax-free. So the money grows inside the policy tax-free. And then when you borrow it out, the loans are, by the way, are not taxable. And then it gets passed on. That's the death benefit, tax-free guaranteed. Okay. Policies are exempt from judgments and liens in most states. So it's a protected asset, unlike most other financial vehicles that are not. And then you can create tax-free income in retirement. You can actually do that because that's called, taking a loan out, not paying it back. That's tax-free income. Okay. Lisa, how is the death benefit decided? Do you choose that, or is it figured out by age? So the death benefit is a result of how you fund the policy, your deposits, and things like that. It's not we don't start with a death benefit. It's a result of how you start the policy and how you fund it. And it's age, location, gender, how amount you put in, all that kind of stuff, or what dictate that death benefit. And then it goes up from there. Okay. And then Angie says, does it have the living benefits? Well, those are critical, terminal, and chronic illness. Those are called accelerated death benefit riders. They do. So all policies have those on there. At the beginning, there's no cost to them. They're added there automatically. Good question, though. All right. Keep those questions coming in, by the way, too. All right. So let's talk about the death benefit. So in this illustration here, this is a female, 42 years old. She's going to put in $20,000 for 5 years and then reduce it down to around $3,257. Okay. So that's 20, 40, 60, 80, $100,000 in the first 5 years. Okay. Look at the death benefit. $325,000 year 1, 364, 403, 443. At year 5, it is $483,000, and she's put in $100,000. So the death benefit is almost 5 times what this person has put in. And look, she reduces her premium down because she wanted to at year 6, but the death benefit still goes up. It keeps going up no matter what. Pretty cool. And she has access to all this cash value to go do other things with during those years. So this is an example of how that generational wealth is done. And the longer this policy is in place, the more and more of these numbers, grow. So by the end of, she's 42, maybe when she's 82, that death benefit might be, well over $1 million. Yeah, Tom, I'll go through that here in a moment. Yeah, good startup numbers. All right, policy loans. Policy loans, by the way, they're guaranteed. So when you go to get a loan from your policy, it's guaranteed. There's no qualifications. There's no credit check. There's no approval. None of that kind of stuff, right? Ask and you shall receive, pretty much. Okay, and you log in, request it gets to you. Loans are private, by the way. So they do not go on your credit report. They do not affect your credit. They're private loans, by the way. There's no minimum or maximum payments. You are the one in control. If you miss a payment, well, there is no required payment, so nothing happens. So you choose how and when to pay these loans back. There's no annual payment, no monthly payment, no statements. So you are the one in full control. Angie says, why is the initial face amount $62,000 on that initial one? That's what's called the base policy death benefit. The death benefit you see on that is made up of a couple different things. That's just the initial one from what's called the base premium. So, and you would see that on you'd know what that means on your own policy. I'd walk you through that. But yeah, that's called the initial death benefit, what that's called. All right. So let's talk about how you can fund the policy. Okay. So I think Thomas asked this question. So how can you fund the policy? Well, you can do it with the premium deposits. Those are monthly, they're quarterly, they're annually, and you can choose that, and you can change it too, by the way. Okay. You can change it. The minimum recommended. Now, this is just a starting point, by the way, but the minimum you can start with to make a policy work is 10 times your age per month. So if you're 50 years old, 500 per month. But the maximum you can put in is anywhere from 15 to 30% of your gross revenue or gross income. So if you make $100,000 per year, around $2,000 per month would be the maximum premium deposit per month that you could put towards a policy. Okay, generally speaking, and it's different for everybody a little bit. Now, on top of the premium deposit, you can also do what is called a large dump-in. Okay, a large dump-in. By the way, this is Molly right here. She's getting very excited. But yeah, you can do a dump-in. Okay, and that's a maximum is something. It's about 8 times your premium. But you can do a dump-in up front. Shane. I think he did one of these ones as well. I'm not sure if he did or not. Can't remember. But yeah, so when you do that dump-in, you jump the cash value up right away, and you can borrow within the first 30 days. And you get larger dividends right off the bat. So Anthony, you did a dump-in. Yeah, I thought you did, yeah. And so roughly speaking, between 50 to 90% at the beginning of the policy, between 50 to 90% goes to cash value within 30 days. So then it gets better and better. So eventually that would be 150%. By the way, it keeps growing better and better, okay? So the question I always ask people is like, when you think about this, when you look at it down the road, would you put in $1 to get $3 back out? Yes, you would, of course, right? Everybody's going to want to do that, right? Makes sense? That's what this does. So the longer you put this in place, the longer you fund it, the more and more efficient this strategy gets. Okay. Let's see here. Barb says, my husband has CLL, very low growing leukemia. He probably wouldn't qualify. So the policy could be done on someone like you, by the way. But that's one of the challenges with, if you have something like leukemia. We'd have to check though with the different types and things like that, but typically that would be challenging. But you can always do one on adult kids, grandkids, spouse, etc. Jeanette asked, would husband and wife want one policy or separate? They're separate. So when you get a policy, it's on an individual. So in a lot of cases, I just did this for a couple. We did 2 policies on both of them, very equal amounts on both, so they had full coverage in the household. But that's a life insurance question right there. But typically, I would recommend 2 policies if you both want to have coverage. Yeah, but mainly they're going to go look at the income earner first. Angie, cash value grows faster through annual versus monthly. Correct, it does. Not a lot, but it does grow faster with annual premiums versus monthly premiums because the dividends are earned on the balance in the policy on a daily basis. Okay. What percentage? So Tom's asked, what percentage meets a dump-in on a $250,000 whole life? So I think if you're referred to the death benefit, I would need a lot more information to answer that question because the death benefit and stuff is based upon age, gender, location, income. It's all these different factors. So that's why we don't really start with death benefit. We talk about more about the policy premiums and what you want to fund it with and what you're going to use it for. Then the death benefit is a result of that calculation. Frank, what if you are retired? Well, it depends on your income. So your cash flow and your liquidity. So the way they qualify you is based upon financials, right? That's going to be based upon gross income and liquidity. So that's going to be the numbers. Yeah. All right. So I want to give you an example here of another policy. This is an illustration of how they can be very efficient with those dump-ins. Okay. So on this one, this person is a 32-year-old female putting in $10,000 per year. They're doing annual and a $50,000 dump-in. Look at this. $55,000 of cash value at the end of the first year is available. That's like a 97% of the cash value versus what they put into the policy. Pretty powerful. Okay. But look at this. Look at year two. They put in $10,000 and get $10,607 of cash value increase at the end of the second year. That's including dividends. So it's already very efficient. But look at this. At year 11, they drop the premium down. They put in $3,000, but it goes up by $10,000, more than 3 times what they're putting into it. So you can see how these things, the longer they're in place, the more and more and more efficient they get, and they get very powerful, right? But pretty cool. Okay. Now, this is a quote that Warren Buffett says, and I really don't like this quote all that much, but I always put it in here. But it says, if poor people would just do what rich people do, they wouldn't be poor anymore. What I actually believe the statement should be is, if poor people had the knowledge of the wealthy, they could change their life. That's kind of more what I look like, because it depends on what you do with that knowledge, right? Right? If you have that knowledge, you got to take action on it, right? A lot of people have access to knowledge, but they don't take the time to learn it, to reprogram themselves, to gain that mindset, and then take action on it. You got to do all those things. Otherwise, you're going to remain in the same situation. Okay. But yeah, but Warren Buffett's a pretty smart guy, that too. So, all right. So guys, so once again, to schedule a call with me, it's brian.beyourownbanker.com/TBCT. I'm going to go ahead and put that in the chat box again here. Let me go ahead and grab it. So you guys have it there. There we go. All right. And then Beatrice says, I'm looking to possibly set up an account for my 18 and 20-year-old daughters. What's the minimal amounts to set this up? I mean, anywhere from 180 to 210 per month would be the minimum to get it going for them. Yeah. Yeah. And yeah, Shane said, yeah, the books we mentioned earlier come in very handy. They do. They're good books. I definitely recommend those books. Yeah, for sure. And then some quick stuff just about me. So some people ask, well, Brian, why should I do this with you versus, this other, my stepbrother over here, right? So I've been teaching infinite banking now for like 9 years, teaching it for a long time. I learned it from, an expert that still does it to this day. We here at the Money Multiplier, though, and BYOB, we have an entire team that works with you to set up IBC. So we have over 40 people that work together to make this work for you. Our team is one of, if not the largest producer of infinite banking strategy policies here in the US, because we have a lot of resources. We've been doing it in our own lives for a long time. We're all licensed by the Nelson Nash Institute for Infinite Banking. So we do a lot of this, but we have a lot of repeat clients. That's why we have a lot of repeat clients, a lot of referrals because of people's experience with this strategy. I currently have, I think, over 100 clients in underwriting right now that I'm working with personally. And we have ongoing support and services. There's no cost, no fees either, but we have a lot of ongoing support and services. So somebody mentioned it already that we do that, right? So yeah, and Anthony, I appreciate that. And then Paul says, yeah, yep, retraining the brain. Exactly, Paul, right there. We're retraining the brain. Yeah, Lisa, exactly. Yeah, you learn something new every time from all the different mentors that we have here on our team. So Lisa knows that, yeah. And then Monica says, how about for myself? Is it the same if I have a whole life with Primerica that it is an agent that gives you, let's see here. So Monica, so no, it's not the same thing at all. Primerica, no, it's definitely not. $74 per month is not going to be infinite banking anyways. You couldn't even do it for that amount, but it's definitely not the same thing. These are specially designed. That's not. It's just a traditional off-the-shelf whole life policy, and most likely. Okay, yeah, Juan, yeah, awesome. Hey, Juan, how you doing? I know him. Thank you. And then Barb says, at age 70, are you saying the minimum monthly would be? Yeah, it would. Yeah. So Barb, that is one of the challenges. It's 10 times your age per month. So minimum would probably be around 700. Correct. Yep. Okay. So another question we already got this one. Is IUL or VUL infinite banking? The short answer is no, it's not. They pay some of the highest commissions. We take a 70% cut in commissions to do infinite banking, but IULs and VULs by their very nature are not infinite banking because they're tied to the market. They're tied to volatility, and they're not infinite banking in our opinion. And then the Nelson Nash Institute, by the way, will not even do or let you be part of their group if you're doing IULs for infinite banking. They won't touch you. And there's a lot of videos that we have on IULs and VULs and the ins and outs of how they work. We've had experts that do IULs come to us and talk to us about IULs and why they believe they're not infinite banking as well. Yep. So definitely not. And we only do infinite banking strategy. That's what we do. We don't do like car insurance or home insurance. We're all entrepreneurs, investors, but we do it with whole life. Okay. All right. So Rob says, in terms of being non-direct company like Lafayette, does that only apply to the annual dividend payout? Well, what it means when you say direct versus non-direct, if you go with a direct recognition company, when you borrow from the cash value, it can impact the way the dividends are calculated. So the dividend calculation might go down. Depends on how they set up the policy, but we don't really do direct recognition. We only do non-direct because we don't really want to interrupt the compounding interest. Yep. Good question. So Monica, sorry. So monthly payment with you, minimum month for whole life is around 180 to 210. Correct. It's 10 times the age per month. 18 years old, 180, 21 years old, 210. Yep, exactly. Marcus says, can you transfer IUL to infinite banking policy? Yes, you can. Called a 1035 exchange, but you can do that. So kind of an interesting question I always ask here in life, right? There's two things are going to happen. We're going to live and we're going to die. We know that, right? Are we better off while we're alive with infinite banking? Yes or no? I believe yes. Are we better off with it when we die? Yes or no? Well, there's a death benefit tied to it, so you're going to make the next generation wealthier. So yes. So I always kind of believe that. And then Monica, can I switch over to you guys from Primerica? Yes, you can. We just have to schedule a call with me and we have to go through what it would look like to make sure that it makes sense. Yeah, so Lisa, so if you want to go ahead and send me an email, I'll send you out the link, or you can click my call link, and I think I have it in there as well. I can't remember, but I'll put my email address and call link right in here again. My email is brian@chrisnaugle.com. So there it is right there. So the kind of I only got a couple more minutes, but during my journey to infinite banking, when I first learned about this, I was the guy on the left. I was like, I don't need any help. I don't need to do anything different. I was kind of a little bit stubborn. And it caused some problems, I'll be honest. And so when I first learned about how this worked, I was like, you know what, I'm going to go do this myself. Or I had somebody else set it up and it was a horrible policy. I still have it, by the way, but it didn't work the way that I thought. But once I learned how this really worked, then I became the guy on the right-hand side. I got control of everything and it really made a lot of sense. So I kind of, like I always say, there's two groups you can be in. There's group one or group two. I always want to be in group two. I want to learn from those people that do it the best. And that's kind of where I believe that we are. I'm just tooting my own horn here a little bit, but I believe we are one of the best companies out there that do infinite banking. And I learned from a very good person as well many, many years ago. So I was very fortunate to find someone that did it the right way and learn from them. So, yeah. So bottom line is, like, let's just see if infinite banking is a fit for you. That's what the calls are that we do. There's no commitments, there's no cost, no fees, nothing like that. It would be directly with me. But yeah, we would just go through sort of your situation, the questions you have, seeing how it can work, the numbers, and just get clarity on what it can do for you. So that's really what we do and how we do infinite banking. So I like to end with this quote that we started at the very beginning with. The problem in America isn't so much what people don't know, right? It's what they think they know that just ain't so. So a lot of what we went through on this call was saying, hey, what do people think that probably just isn't the right way of thinking, right, around money? So there you go. All right, guys. Any last minute questions you got for me? When the policyholder passes, can it be assumed? No, it can't. So when something happens to you, the policy matures, they call it, and then the death benefit pays out. That's what happens. Yeah, Anthony. Yeah, I finished in the allotted time. I was speaking faster today, by the way. Typically, I go a lot longer because I speak a little bit slower, but I speak fast naturally. So yeah, I try to get it within the 90-minute mark this time. Rob, yes, you can. Yeah, just schedule a call with me. Yeah, schedule a call with me. Not a problem. And yes, and Frank, yes, this will be on YouTube. So we do have a replay that we put on YouTube. It'll be like, maybe 5 days down the road, this will be on there. So you can always go watch the replay there. Or you can always send me an email if you want to just grab it and I'll just send you the link to the email. Or I'll send the link to the replay. Awesome. Well, great meeting all of you guys. If you guys are here for the first time, appreciate you being here. And then, of course, for all of you that have been here many, many times, appreciate all the comments and the feedback and all that kind of stuff as well. But with that, I will see some of you tomorrow. By the way, we do have a lot of other events and presentations that we do. So on Wednesdays, we have 3 events. We have we have the Wealth Wednesday webinar. I'm not sure what they're doing tomorrow for that one. We have the WTF presentation that Chris and Steven do. I do it as well sometimes. And then we have our Ask Me Anything, where you can come on and ask questions live of myself. Typically, Chris and other agents are all on there, are my colleagues, and we answer questions live. So you can grab a link, or sorry, go to Chris's YouTube channel, I think, and subscribe there, and you'll get notified of those live stream events. And then you can go to chrisnaugle.com, and there'll be an event link or thing there, and you can go look at the times of when those events are. So just go to chrisnaugle.com, EB, and then you'll see events and resources down there. And that's where you can start to see the different events that we do every week. We do like, I think six events every week. Yeah, and this is one of them right here, by the way. So, all right, guys, with that, take care, and I'll talk to some of you soon.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.